In recent discussions across financial media and online platforms, there has been a noticeable surge in opinions about gold, silver, and the broader direction of the global market. Some voices suggest that precious metals are losing strength due to a stronger currency environment and shifting geopolitical developments. Others argue the exact opposite, claiming that the current situation guarantees a powerful rise in these assets. The truth, as is often the case in financial markets, sits somewhere in between these extremes, and understanding that middle ground is what allows a person to think clearly instead of reacting emotionally. What we are witnessing is not a simple story with a single cause. It is a complex interaction between global uncertainty, monetary policy expectations, energy market movements, and investor psychology. These forces do not move in a straight line, and they rarely deliver clean, predictable outcomes in the short term. When geopolitical tensions appear in headlines, markets often react immediately. Prices shift quickly as traders attempt to interpret risk, often before all the facts are fully understood. Then, as new information emerges or earlier assumptions are challenged, those same markets can reverse direction just as quickly. This creates a pattern where price movements appear confusing or even contradictory. For example, a rise in global tension might normally be expected to support gold as a traditional safe haven asset. However, if that same situation leads to higher energy prices and renewed inflation concerns, it can also strengthen a currency and push interest rate expectations higher. In that environment, gold may struggle in the short term despite the presence of uncertainty. This is not a failure of the asset. It is simply the result of multiple forces pulling in different directions at the same time. One of the most important elements in this environment is the behavior of the currency market. A stronger currency can place pressure on commodities, including precious metals, because it makes them more expensive in global terms. At the same time, interest rate expectations influence how attractive non-yielding assets like gold and silver appear, compared to interest-bearing investments. If markets begin to believe that interest rates will remain higher for longer, or that policy easing will be delayed, this can create temporary pressure on metals. On the other hand, if economic conditions weaken or inflation remains persistent without strong growth, that same policy environment can eventually support metals again as a form of financial protection. This dynamic creates a situation where short-term movements do not always reflect long-term reasoning. Another important layer in this discussion is inflation. Official data may show that inflation has cooled compared to previous peaks, but it has not necessarily returned to levels that feel comfortable for policymakers or households. When inflation slows but remains elevated, it creates uncertainty about future policy decisions. This uncertainty is important. It means that policymakers are not operating with complete confidence. They are balancing risks, watching data closely, and trying to avoid making decisions that could worsen either inflation or economic slowdown. In such an environment, markets do not move with clarity. They move with hesitation, reacting to each new piece of information. Energy prices also play a major role in shaping expectations. Even without a major disruption, the possibility of supply concerns can push prices higher. When energy costs rise, they affect transportation, production, and daily living expenses. These effects gradually spread through the economy, influencing inflation and consumer behavior. This does not require a permanent crisis. It only requires enough uncertainty to change expectations. As expectations change, markets begin to adjust. Investors reconsider risk, companies reassess costs, and policymakers face new challenges. This process can take time, and during that time, prices may move unpredictably. Now, when looking at precious metals specifically, it is important to understand that they are not driven by a single narrative. Gold is often viewed as a store of value, particularly during times of uncertainty. Silver, however, has a more complex identity. It is both a monetary metal and an industrial resource. This dual role makes silver especially volatile. It responds not only to financial concerns, but also to industrial demand. As a result, it can experience sharper movements in both directions. When silver rises, it can do so quickly, but when it corrects, those corrections can also be significant. This is part of its nature, not a sign that the broader story has ended. Supply and demand also contribute to this dynamic. While supply can increase through mining and recycling, it does not always respond quickly to price changes. Much of silver production comes as a byproduct of other mining activities, meaning its supply is influenced by multiple industries, not just its own price. At the same time, demand continues to come from various sectors, including technology and energy-related applications. This creates a balance that is not static. It shifts over time, depending on economic conditions and industrial needs. Because of this complexity, it is not realistic to expect silver to move in a straight line. It is also not realistic to assume that any single price movement defines its long-term potential. Gold, while generally more stable, is also influenced by multiple factors. Central bank activity, global reserves, and long-term economic concerns all play a role in shaping its direction. Even when prices pull back, the underlying reasons for holding gold may still exist. One of the broader themes that continues to appear in discussions is the growth of global debt. While different analysts may interpret this in different ways, the overall trend is clear. Debt levels have increased significantly over time, and this creates long-term questions about sustainability. These questions do not always lead to immediate market reactions. However, they influence how investors think about risk and value over extended periods. As confidence in financial systems changes, even slightly, it can lead to a gradual shift in behavior. Investors may begin to diversify more broadly, looking for assets that are not directly tied to traditional financial structures. This does not happen all at once. It happens slowly, often without clear signals. But over time, these shifts can become meaningful. Another important factor is investor psychology. Markets are not driven only by data, they are also driven by emotion. Fear, confidence, uncertainty, and expectation all influence decision-making. During periods of volatility, emotions tend to increase. People react more quickly, sometimes without fully understanding the situation. This can lead to exaggerated movements in prices, both upward and downward. In such conditions, patience becomes valuable. The ability to step back, observe, and avoid reacting impulsively can make a significant difference. It is also important to recognize that markets often challenge expectations. They may move in ways that seem illogical at first. They may contradict widely held beliefs. This is part of their nature. Short-term outcomes do not always align with long-term reasoning, and long-term trends do not always develop on a predictable timeline. This is why simple explanations can be misleading. Statements that suggest a guaranteed outcome, whether positive or negative, do not reflect the complexity of real markets. Instead, it is more useful to think in terms of possibilities rather than certainties. For example, it is possible for precious metals to experience further short-term pressure if currency strength continues, or if interest rate expectations remain elevated. It is also possible for them to recover if conditions shift in a way that supports their role as financial protection. Both outcomes can exist within the same broader narrative. Understanding this allows for a more balanced perspective. It reduces the likelihood of being influenced by extreme opinions or emotional reactions. Another key consideration is the everyday experience of individuals. While official data provides important information, personal experiences often shape perception more strongly. If the cost of living feels higher, if expenses increase faster than expected, or if financial stability feels less certain, people naturally begin to question the system around them. These questions do not require technical analysis. They arise from daily life. As these perceptions spread, they can influence behavior. People may look for ways to protect their purchasing power or reduce risk. This can contribute to ongoing interest in alternative assets, including precious metals. However, it is important to approach this carefully. No single asset provides a complete solution. Each has its own risks and limitations. Diversification, awareness, and realistic expectations are essential. It is also worth noting that large financial markets operate on different timeframes. Some participants focus on short-term movements, while others focus on long-term trends. These different perspectives can create conflicting signals. What appears weak in the short term may still be part of a larger structure, and what appears strong may not always be sustainable. Recognizing these differences helps avoid confusion. In the current environment, there is no single dominant narrative. Instead, there is a transition taking place. Markets are adjusting to changing conditions, and that process involves uncertainty. This uncertainty can feel uncomfortable, but it is also normal. Transitions are rarely smooth. They involve disagreement, volatility, and changing expectations. For those observing the market, the focus should not be on predicting exact outcomes. Instead, it should be on understanding the factors at play and remaining adaptable. Watching key elements such as currency strength, energy prices, inflation trends, and policy signals can provide useful context. At the same time, maintaining emotional discipline is equally important. Markets often create situations that test patience. They can appear convincing in one direction before reversing. They can reward caution at times and punish it at others. There is no perfect strategy that avoids all risk. What matters more is consistency in thinking, awareness of uncertainty, and the ability to adjust when conditions change. In the broader picture, the global financial system continues to face challenges. These challenges are not new, but they are becoming more visible. Debt levels, policy constraints, and economic pressures all contribute to a complex environment. Precious metals remain part of that conversation, not because they offer guaranteed outcomes, but because they represent an alternative form of value. Their role may change over time, and their prices may fluctuate, but the underlying reasons for their relevance have not disappeared. At the same time, it is important to remain grounded. Extreme scenarios, whether positive or negative, should not be treated as certainty. They are possibilities, not promises. Balanced thinking allows for better decision-making. As markets continue to evolve, there will always be noise. There will always be strong opinions and dramatic headlines. But clarity comes from focusing on fundamentals rather than reactions. In the end, the goal is not to predict every movement. It is to understand the environment, manage risk, and make informed choices. Staying calm, staying informed, and avoiding extremes is often more valuable than trying to be perfectly right. This perspective does not remove uncertainty, but it makes it easier to navigate. And in a world where conditions continue to change, that may be the most important advantage of all. This content is shared for educational purposes based on general market observations and widely discussed themes. It is not financial advice, and it does not suggest any specific action. Every individual should consider their own situation and think independently before making decisions.